Most beginner traders believe that gold moves randomly. One day it rises sharply and the next day it suddenly falls. But when we zoom out and look at the bigger picture, a very interesting pattern appears. During times of global crisis, war, or economic panic, gold often begins to rise very quickly. Sometimes it even explodes upward. In financial markets, there is a concept known as safe haven assets. These are assets that investors trust during times of uncertainty. When the world feels stable, investors prefer stocks, business investments, and riskier assets. But when fear begins to spread across the global economy, investors start looking for something safer. And historically, one of the most trusted safe haven assets has been gold. This trust did not appear overnight. Gold has been used as a store of value for thousands of years. Even before modern currencies existed, gold was already considered real money in many civilizations. Now let's imagine a global crisis. It could be a war, a financial crash, or a sudden economic slowdown. During these moments, fear spreads across financial markets. Stock markets become unstable, businesses become uncertain about the future, currencies can lose value. And when investors see this uncertainty, they begin to move their money into assets they trust more. One of the biggest destinations for all capital is gold. As more investors rush to buy gold, demand increases rapidly. And when demand increases, the price rises, sometimes very quickly. This pattern has appeared many times in history. For example, during the 2008 global financial crisis, investors across the world lost confidence in many financial institutions. And as fear increased, gold prices began rising strongly. A similar pattern happened during the 2020 pandemic crisis. Global markets were uncertain, economic activity slowed down, and investors once again moved toward gold. This is why experienced traders closely watch gold during times of instability. There is another important reason gold becomes attractive during crisis. Most modern currencies today are fiat currencies. This means they are created and controlled by central banks. And during major economic crises, central banks often start printing more money to support the economy. When more money enters the system, the value of that currency can sometimes weaken. Gold, however, cannot simply be printed by governments. Its supply is naturally limited. And that is exactly why many investors see gold as a protection against monetary instability. So when crises appear, two powerful forces begin to work at the same time. First, investors move their money away from risky assets. Second, they look for something that can preserve value. And historically, one of the strongest beneficiaries of that global fear has been gold. Understanding these relationships help traders see the market with a much wider perspective, because markets are not just charts moving randomly. They are reflections of global economics, politics, and human behavior. And the more we understand these forces, the better we understand how markets truly move.